We've just witnessed something pretty unusual. 6 weeks straight up for the markets, and it hasn't happened in over 5 years. So what happened last time? Today we take a look at that in our special weekend show of the markets around the world, where we cover stocks, commodities, and cryptos together. We'll also be taking a look at whether the Grinch can come this Christmas. Yes, will a sell-off be actually good for the stock market in 2024? The results, I'm sure, will surprise you. And we need to talk everything yields, because we saw oil finally find a little bit of a resurgence, breaking through one of our key levels on Friday. At the same time, we also saw yields spike off their lows. So could this week finally be a week of sell-off, or is it just going to be more bull runs into trillions of dollars of options expiration? Well, welcome back, everybody, to the special weekend edition of the show where we talk about markets around the world. My name's Tom. We've been running this for over 3+ years together. And of course, if you like anything to do with macro lead indicators or the hottest charts, make sure to subscribe and smash that like button. Let's talk about the week in review. Energy was down and AMD was kicking ass. That was pretty much the main storyline. And of course, if we take a look at the Friday in terms of performance, it was pretty much just like up and down across the board. Some stocks doing well, some stocks doing poorly. A big reason why we did see a bit of a rally was, of course, the November employment report. And we did have a fairly hot number, 199,000, and jobs went to 3.7% unemployment rate. But it's the same old story. It was counteracted by the September number, which was revised down by 35,000, 297 to 262. It continues to be a joke, this number, in terms of what's been happening in the US. And I always encourage people to think about the liquidity grabs that tend to happen. And it was the same story that happened on the Friday. It went off in a direction down and then rallied straight back up. And it happened across most things, including stocks, commodities, and currencies. Let's now discuss what happens in December. So we've brought these charts up before, but there's some big ones coming that might surprise you. First up, sideways action is pretty common in most years. 70+ years of data basically really says that around the middle of the month, we tend to see a bit of a bullish move in markets. We know that if we took into consideration just strong years coming into December, we did tend to see some weakness at the start, kind of like that middling point. And then we started to go for the rally. And so far, we have just basically seen coiling, possibly a new breakout high that just occurred, which we'll talk about later on today's video. But yeah, we need to be very, very cautious here because, of course, the market is dull, and that means it continues to melt up quite slowly. Let's talk smart money versus dumb money confidence spread. We already talked about how this is quite wide. Now, a big portion of this, I believe, is because of the CTAs, which we'll look at later on. So we have seen smart money start to sell into dumb money, which is us. And basically, that's that coiling action. Now, remember, these have become spread before, and it took some time for it to actually turn around. In fact, there was quite a few percentage points of melt up before the markets actually came back down to our perfect 4,200 to 4,100 level. Now, we kind of expected that to occur last time. It took ages, and that can be sometimes not on your timesheet. So make sure to subscribe to our latest newsletter, because I'll be talking a little bit more about what we've got in store in terms of the stats moving forward into 2024 as well. Check it out. Links in the description down below. Let's discuss volatility this week. Of course, JP Morgan have come out and they've said volatility is expected to go up. Well, yeah, of course it will, because of this week is trillions of dollars of options expiration, and it could bring into consideration maximum pain, a concept that we only use once a month, and it has to do with the third week options expiration. So here's the volatility that's expected to spike. Will it actually happen? It's been very low recently, and that's led into some of the cheapest options pricing hedges that we've seen in quite some time. So here's where some data comes in that I think is pretty interesting. This has got to do with the Grinch. Now, what the Grinch is it's the 3 trading days before Christmas, and then it's the 3 trading days after Christmas, okay? So 6 trading days in total. Now, here's where it gets really interesting. If we have a negative Grinch this year, so that is that the market actually sells off around those 6-day periods, did you know that January has a massive chance of being bullish? And on top of that, we've also got this huge chance that we actually have a good year. So read these stats here. Since 1950, a negative Grinch has been followed by a positive January in 16 of 19 years. average movement is plus 4.3%. Wow, that's a big number. And a positive calendar year in 18 of those 19 cases. So again, a bull might actually want a Grinch this year. To the contrary, 11 of the 12 S&P 500 double-digit loss years since 1950 were followed by positive Grinches. So you can see here 2022, and of course, what happened when we talk about the Grinch, and then we had a very big negative year. So it actually could be counter. We don't want Santa to come this year. We actually want the Grinch to come in terms of what the data represents. So what about this week? Well, here's this week's OPEX, and you can see that actually December OPEX can be quite positive. The week coming in usually is 73.2% positive, and then the week after is generally 75.6% positive. But interestingly, the options expiration day is not that positive, only 56.1%. So kind of like a standard day, I would guess, in the markets. Let's also talk about whether all of this aligns to having one of the best months ever on the stock market. Yes, the 18th best month since 1950 was November of 2023, 8.9% booked. And you can see that in most times we do end up eking out a 1% gain for the next month, but there's actually quite a lot of reds in there as well. So again, if the Grinch was to come, that actually wouldn't be a very negative thing. Keep that in the back of your mind. We'll bring up the Grinch stat a few times on this channel so we don't lose sight of it. Let's talk Magnificent 7 now, because of course this has been the rage of 2023. What is the total US single stock net exposure? Well, as it turns out, it's actually declining. And this is interesting because we've also seen cumulative trading flow showing us that markets have been moving out of the Mag 7 for a little while now. Here's the long flow, which was massive into September. Then we saw the sell-off in the markets. And of course, now we've gone back into kind of like a neutralized position for the Mag 7. What's that telling us? Well, the net flow is down so much, it's kind of showing that rotation is in the undercurrent, and that's what people have been looking at. We've been talking about the mid caps and the small caps potentially outperforming, and we're getting a lot of financial reads as well, which I'll share in our newsletter this weekend, which are kind of showing you that maybe breadth is starting to improve across the board, which could be good for the bulls. Again, the bulls do not want necessarily a positive Grinch though, because that could be quite bad. So this week is everything to do with the Fed. The Fed is going to make its decision on interest rates, and we already know that the expectation is nothing's going to happen. You can see here the data stats. We continue to see tons of people expecting many cuts in 2024. And again, I think the Fed is going to make probably the decision to hold it. Remember, if they've held it for the 5th consecutive month, so +5, that means that in no history point ever have they ever risen the rates again. So they're pretty much done at that point. And the market's already speculated on this, but of course that's the stats and that's the facts. Let's talk S&P 500 bottom-up target price versus closing price. So you'd be surprised at what everybody thinks the market's worth right now in terms of expectations and analysts. They've got a 5,068 read on the markets. Yeah, that's pretty high considering where we are right now, but this is the bottom-up target as of today's date. And you'll notice that there's actually a bit of revisions to the downside, followed by just a few more positive revisions over the last couple of weeks. So this is a big reason why the market was also able to sell off. Now, when you start to see down revisions, that can push market narratives, but at this stage, it's pretty stable, I'd say. And the market is looking at 5,068 for the next couple of years. Bottom up target prices, you can see here what the expectation is and what the reality has been over time. The expectation for 2022 was looking really good, and it certainly didn't live up to expectations. But that's what happens sometimes in the markets, and it's just an interesting stat. So what about the difference between the median target price and the closing price? So according to FactSet here, we have some very interesting stocks that are super different to what the 12-month targets are or the median targets are on these stocks. First Solar, Moderna, Wynn, Las Vegas Sands, all of these particular stocks are some of the considered biggest differences. Look at the target prices they have for some of these. Moderna is in focus, $80 versus $116. But do remember, a lot of the time this is because they haven't updated their target specs expectations, or there could be something else underfoot. I like to look usually not at the most extreme ones and instead more in the middles. And we'll be bringing those into the show as we move forward. Earnings growth, here are the sectors in terms of what's the expectation. Energy, materials, and healthcare are expected to have pretty poor earnings growth. And you can see that when you're talking about laggards. So these are the things that haven't been keeping up with the markets. Have a look at this: staples, materials, healthcare, utilities in the 4 worst versus the S&P 500 for 2023. Now, these could also have some interesting ones. I noticed that supposedly Nvidia and Microsoft believe that industrials have one of the best instant gains off AI technology. Is that true? I don't know. Do you think it is? Let me know in the comments down below. Financials also, infotech, consumer discretionary. I would have to believe financials would have quite a lot of gains to be had out of AI as well. But it's an interesting point. And these are all super behind right now. So will they start to rotate through? That is the question. S&P 500 has been giving us some breadth thrusts. We've first started off with the Whaley breadth thrust. Then we had, of course, every other one of those rare Zweig breadth thrusts and a few others. Now we've got a 20-day breadth thrust, which shows us usually that in 1 year's time, markets are pretty positive. 96.6% of the time after a read such as this, we have a positive market in 12 months time. Now that doesn't mean we won't get huge amounts of up, down, and all around. So still expect 2024 to be a pretty wild year, and we'll be following it along with you, and together we'll hopefully be able to navigate these markets a little bit better. What's going on with China? So outflows, foreign direct investment in China is out, and I guess India is now in. So yeah, this was the first time we've seen this pretty much, I think, ever. And that happened in Q3 of 2023. At the same time, we saw downgrades across the board, which of course Moody's downgraded China again, which they've done a few times before, 4 times before. Now, funnily enough, whenever they put a nice downgrade in, remember, they're not usually in your best favor. What has happened is we've usually had positive years thereafter. Plus 9.8, plus 41.8, plus 89.3, and plus 19.8 were the percentages for this particular index after Moody's downgraded them in the following year. Do you agree with that? Again, it's going to be an interesting point. So what about sentiment in the markets? We already know that everybody supposedly is bullish and that a lot of the neutral people went bearish over the last week, allowing for a kind of nice choppy market to be one of the perfect factors because of this factor. And when we take a look at it, you'll see what I mean. So retail investors aren't quite at their all-time peaks like they were over in these periods over here. But what we have seen is huge amounts of retail traders doing the exact opposite to what they're saying. And that is try to short the market. Yes, most people have been opening short positions, and we've really reported on this for a few weeks now. 81% of bearish positions, the DAX remaining at 87% bearish positions for quite some time. And usually when you're starting to get into these 87s and 90s, you are starting to look at maybe the end of that bullish run because it's really pushed that narrative so far. But yeah, we have a huge amount of people going against the market. And it shows again when we have a look here at TD Ameritrade clients. Take a look at this. Everybody was actually going negative in markets recently and trying to short it off while it's been melting up. So unfortunately, we haven't had some good reads other than the NASDAQ, which we'll talk about later on today's show, that even showed any type of shortness. Basically, the S&P 500 has maintained a series of higher highs and higher lows. The NASDAQ showed some weakness. And of course, the Russell, we've been on the bull train for at this stage. So again, we'll check it out soon. What about Goldman Sachs though? What about the CTAs? What are the estimates moving forward? Well, this is still a relevant chart. It basically shows that chop or even down CTA movements are needed. After such a huge bullish injection of CTAs, we are starting to see a bit of a movement round. And most recent reports are showing that we have CTA kind of diverging here against the S&P 500 and of course the Qs. Now, we showed a good chart also in one of our previous videos where we talked about oil and the impact of CTAs. Notice that the markets over time do actually connect back to these CTAs, but now we have a huge divergence between them. I want to just reiterate here, when we're talking about these stats, it doesn't mean it happens in a few days' time. It is something that can take even months to occur. But it is interesting to see how disconnected they've been. One of the biggest disconnects that we've had in quite some time. Certainly worthwhile considering. Now, gold bugs. We've been talking gold bull for a long time, ever since really 1820 to 1860. I've been super bullish on gold. And that all continued up until we saw that huge Monday close. Well, Monday open, really, where we hit 2100 plus an ounce. And yeah, it was all over at that point. Now, what I mean by all over is it means sideways action is the most statistical likelihood. You can see here 3 months later, after similar reads, only 20% of the time was gold up. And gold's actually suffered one of the worst weeks after that stupid Monday blow off, which probably executed so many people that had shorts and just completely wiped them out. It's the same thing for gold stocks, which usually perform very poorly over a month. Only 17% of the time after similar reads did we even see positive gold stock positions. So something to keep in mind. But let's now talk dark pool activity. Do we continue to see selling or some kind of big transaction through this coiling market? Well, the answer is quite simply yes, we do. We got more S&P 500 reads coming through on Friday. We've also seen a lot of treasury reads, which, again, we've speculated on as maybe some take profits after what a great gain treasuries have done. You can see here semiconductors continue to come through as well, and there are quite a few reads coming in. So these could be accumulations for a big breakout. And of course, you'll want to be looking at semis, which we'll check out in the charts very soon. But these are the types of reads as well that could be in for a Wyckoff distribution. So you've got to keep an open mind here, and especially when the Grinch stat is so interesting, then we need to be on the wary lookout for breakouts, how they're breaking out, whether they're rejecting after that breakout. And I think patience, react, don't predict. So let's now take a look at the unusual options activity. First up, we had a little bit more than normal, 40 versus 39 million. We saw 57% calls and 28% retail puts and call participation. Let's now take a look at the unusual activity. Lululemon striking out at 5.4, but coin was probably the most interesting. 7.7 with a 1.71 read. But notice that we actually had quite a lot of people putting puts on this. I'm surprised people were buying puts on coin at these levels, considering what Bitcoin's been doing in the melt up. But, it makes sense why it would probably blow out at this stage. In terms of the other stocks, we continue to see some rotation into weird little small stocks, things like Block coming back. Obviously, Zoom also constantly in the charts at the moment. And it's more those rotation into what were the favorites at the beginning of 2021. They've tended to do quite well recently. Let's have a look at the daily report. We've got ITB home builders. We've also got regional banks, another good session. And energy came back in a decent way. Semiconductors, technology also up there. And what were the laggards? Unfortunately, tan, and then, of course, gold getting bashed around for the week. And you can see here with the 5-day average that gold was the worst performer of the last week after being one of the best performers in the previous weeks. It's funny how that rotation occurs. But notice again, the regional banking, the home builders, these two sectors coming up is actually quite a strong sign for the next couple of months. And we need to keep watching that because it's going to be a very important factor. Effective yield was down, again, positive for the markets. Let's get into the charts now. Equal weight market held up in its coil and still in a bullish trend. Again, that's good for breadth. Now we move over to, of course, our bond indicator here. Again, looking positive, good for the bull market. We have the American consumer discretionary versus staples, breaking out to a new high. Again, that looks positive. Now, this is something that you might want to keep your eyes on. We kind of speculated that we might be able to see a bit of a spike in yields, bringing down treasuries and, of course, bringing up yields across the board. That's what we've seen so far. So we saw that little spike out. And for day traders and scalpers, they're going to be looking at this because it's basically broken the downward trend. You can see that we've got that reversal, and it looks like now there's a chance that this week might actually bring higher yields. Now, why could that also be? Well, because we have the interest rate decision. Not that I think they're going to do a rate hike. That would be weird. But if they did do it, well, that would be very wild for the markets. But I think it's just going to be that they're going somehow they'll reiterate more about like higher for longer and blah, 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 and that will create the narrative. We've also got treasuries in the supply, which makes sense. And funnily enough, this was an island reversal. So it does kind of point to me to see a pullback here in treasuries into strength maybe in the future. So this is what I'm not negative on treasuries. Don't get me wrong. I've been probably one of the biggest bulls down in these levels compared to others because we talked about the massive volume and I loved it very much. But I still think that around this area, it's due for coiling, which is, of course, a pullback in time, or it's due for a nice little pullback because it's the type of thing that happens. For longer term bulls, they're probably going to still like treasuries moving forward. PCC, put call ratio, sitting around in these lows. So, of course, that's fine, whatever. It's just there. There's a little bit more calls coming in than puts at this stage, and it is very cheap to hedge portfolios in comparison to history at this stage. Dow Jones Transportation Average did weaken off a little bit here, so that's interesting, but that was countered by home builders, which just continued to put in the strength, and it's just been a very, very strong market. Take a look at this. You look at that breakout. I mean, it's just so strong. 1, 2, 3, 4, 5, 6 weeks up in a row, comparing with the market, even stronger. And I want to do the percentage actually here. Let's have a look at this percentage. So it's returned 27% from its lows. Oof, that's a big return. It's kind of almost worrying how fast it's going up. Let's talk about what's going on with central bank liquidity. They kind of hovering at these points. So it's coiling with the market, both the Fed and the world central banks. And we saw copper come back up and reject that level. So this is actually where you see bears coming back in. If you wanted to have a go at copper negative, which I don't, but anyway, if you did want to, this is a very interesting level from a technical perspective. 385 is pretty much where you would expect bears to come back in. We talked about this. I'd like to see, of course, a new 393, and that to show that copper's really improving into the Chinese New Year. But yeah, copper, technically where the bears would have a go at it if they're going to. Let's talk dollar index. So dollar index didn't do quite what I'd hoped. My kind of thought play coming into non-farms was we were going to hit this level and then maybe see a sell. We actually went a little bit higher into the supply, which is totally fine. I mean, we're still hitting that supply. And then we saw a little bit of a sell-off. But you can see it's very mixed signals. And I think a lot of that's because yields obviously went up, and that forced, you know, the hand of markets to kind of say, well, maybe the dollar needs to be higher because yields are going up as well. Interesting supply, certainly one to watch. And you can see now on the weekly that's put in its first green in quite some time. So this is still where the sellers are. If we get above and we hit that 104.45 alert, big things might be coming. Now, gold kind of did as we expected. If we broke this high, we were expecting maybe back to 2075, but we went down, and I just think gold's going to be, unfortunately, a little bit boring moving forward. So we'll see. But yeah, we're looking for opportunities there. Not much to report at this stage for probably a few weeks. Let's move over to oil. Now, this finally became a pretty interesting market. I kind of speculated if we broke through here, we'd be seeing strength. Would have been better to see it pull back a little bit, but I guess at this point, we're kind of moving towards 72 a barrel, which is where that supply sits. So 72 a barrel will be an interesting point. We hit a monster weekly rejection wick here, and you can see that this is a very strong point of previous demand. So I can see why it happened. And yeah, oil finally became kind of interesting, I guess, from the buy perspective. Now let's move over to Tesla. So it didn't actually reject through the week, and it kind of closed in the middle, and it's still trapped between the downward trend line and the upward trend line and the coil in the middle. Let's have a look at this on a 2-hour chart so you can see what I mean. It's just getting tighter and tighter and tighter, getting ready for a big move. Now, there's a bit of this going on in markets. Of course, even the 4604 by the SPY is barely a breakout to the new high. So we're still coiled in a lot of stocks. We're coiled in the Mag 7 as well. And we're waiting for those kind of signs to show us that the melt up's just going to get really ridiculous. But at this stage, Tesla still trapped within, looking for a break either to the high of 254 or the low of 230, 232. Semiconductors are worthwhile to watch as well. We already know there's big trade here, big trade here, big trade here. So are they buys or are they sells? We don't know yet. You could speculate they're buys because, of course, the trend is up, and that would be the most logical conclusion. But it's the same kind of thing with the Mag 7. So if we look at the Mag 7, this is the chart of those visually represented. You know, if we're going to see selling, it's going to happen in here. So the reason is because this was the previous high. We saw a lot of selling in here already, which we've reported on. Well, we assumed it was selling. Then we came back down to the first demand, and then we've spiked back up. Now, if that's all you get, do remember the Mag 7 across the board actually did go down from here 7%. So to claim there's been no sell-off, there technically was a sell-off in the Mag 7 and a rotation into the rest of the market, but that has still started to come off there. Weekly chart showing some strength, no breakout of new highs. We should set an alert above here, which we'll do together right now, so that if that does occur, then of course we know that we're most likely in a melt up across the board. This has been one of the weakest markets, so we'll be paying a lot of attention to that. Let's talk strongest markets now. 1, 2, 3, 4, 5, 6. So most markets have been putting in 6 bullish run candles. So it's not actually impossible for the German DAX to do this. 1, 2, 3, 4, 5, 6. We melted around for a little while, and then we actually went 6, 7, 8, 9. Now, the DAX does something the S&P barely does, which is go that many numbers, and then we fell off. So, of course, we saw a little bit of a pullback, not an extreme one, but that is sometimes what happens in markets. But this is huge. And a lot of it is because 87% of retail traders keep trying to short it. I've said on the DAX, I would not go at this market. It's just not been worth it. And there are no signs of weakness yet on it. Now, the longer this goes like this, there's going to be probably a more aggressive sell that comes through, but we'll look at that on the S&P 500 soon. Here is the US 2000. So the Russell 2000 putting in an okay week after that rejection. You can see here, if bears are going to come in, this is usually where the point is. I'm not really trying to go against the Russell at this stage, but I could see somebody having a go at that with stops above this high. Is it worth it? Well, you're going counter trend. It's generally not the best play, but it is what it is. Let's have a look at the Qs. The Qs, obviously, 16,000 was broken, which is equivalent to this price on the Qs. We're not quite above the new high, nor are we at new lows. So this was still the weakest market over the last kind of sessions. And if you think about it, it makes sense because what we saw usually selling around 16K, and we just never got that new low, which we had for alerts. We haven't got a new high break either. So I think the NASDAQ becomes still the chart we want to watch this week, and we want to be checking it out. Now, non-farm payrolls played the typical game, went negative first, then went super positive, trapped probably a lot of liquidity. It's going to be interesting to see how it plays, but let's go S&P because that's usually the best read. Now, I mentioned this, 1, 2, 3, 4, 5, 6. So we went back to 2017 and we had a look, and you can see over here, this is the last time we saw this many bull weeks. And what actually happened was we just melted into a sideways market. So you might be hoping, oh, I hope there's a big sell-off. Well, as it turns out, there was a big sell-off, but it happened about a month or two later. And then we got this huge crash that came through on the markets. And that's a fairly decent crash. In only 2 weeks, we went from a sell of around 12%. So we basically corrected, which is minus 10 in 2 weeks, sold massively. And then, of course, we ended up finding a rally. But yeah, that's what happens when you go into these really extended markets. And this is still what could be expected. Check out our newsletter. You might be horrified when you see what the Fed does and it comes up with before a Fed cut and also after a Fed cut. Yeah, it could be a while till we see this market actually give us a lot of vol, but I hope it does very, very soon. S&P 500 futures, let's take a look here. So again, if you were looking at this on a chart and you looked at most people from a technical analysis standpoint, they'd say, well, it's still bullish. Let's go to 4,800, yeehaw. And that's kind of what it looks like because theoretically it did break out when you talk about 4,600. We managed to put in a high. We got initially a rejection of 4,600 because of all the options that were around here. Then we basically closed, giving the market almost premium profit. And we've still got these green squiggly lines kind of jumping around down below. Now, if you're a believer that this is all turning into a Wyckoff distribution, this course could be a UT. This could be a buying climax. This could be the first kind of level. So we've got here this idea that this still could be a trap, but you're going to have to practice patience, react, don't predict on this one. Because unless you're an investor or you're just long because you know what, the trend's still long, there's no short on the S&P. Remember, the S&P never broke underneath our 45-20 zone. And because of that, we never really got a good signal towards going swing or day trade or anything short. Only the NASDAQ presented. This is going to just be that area where you've got to be really, really trappy. And I think this week is going to show us a lot. And hopefully, I guess the Grinch does come this Christmas to allow markets to potentially have a nice green year. For some of you, you're going to say, no, I don't want it now. I want the great green Christmas so I get a worse year in 2024. Which one do you want? Let me know in the description down below. The Grinch this Christmas or the non-Grinch? Let's talk maximum pain. So this week is, of course, options expiration, and we know there's almost 3.6 million outstanding options. We also know that we have a couple of walls, but they're not significant walls like we usually get. So we have here the 460. I would say that is barely anything. These people suck, and they're going to lose all their money, unfortunately, which is the 420 puts. Man, there are a lot of 420 puts. I don't know who that was, but wow. it's just so much bigger than the rest. Now, the 435 puts, they're an interesting level as well. 441, technically the best profit cow for the markets at this stage in terms of expiration everywhere. And you can kind of see where the equalization would be, which would be 440 on the dot. So you can really see where it is. Now, if you're taking this into consideration, you'd say another week of chop to downside chop would be the best play, possibly opening up that Wyckoff level. So can possibly opening up this being a rejection zone. We'll follow along with it if that's true. But at this stage, of course, if you look at a weekly, it is still possible. We're getting into that 6-7 weeks. If we do break out again with another weekly, you're going to have to just start saying, well, 4,800 or 4,750 is certainly coming for the markets. Let's move over to Bitcoin now, which continues its melt up in a different way, and it's 43,773. So Bitcoin has been doing pretty nicely. It actually managed to get another high just before on Friday, which you can see here at 44,005. Not quite at 46 to 48 yet, which is really our long-term target here. Well, medium-term target until we get into the halving cycle next year. But I do expect there to be some resistance around this 46 to 48 zone. So we're pretty close, but Bitcoin continues to be in an upward trend. Don't fight it. You know, at this stage, at least that's what we've been saying now for over $10,000 on Bitcoin. It's in a melt up. It's dull. It's hard to short, just like the S&P is hard to short. And we're still looking for significant weakness, which we just haven't seen at this stage. Ethereum also doing quite well with a constant melt up of higher highs and higher lows. For the week ahead, here is the data that you need to be looking at. Of course, we have core CPI coming out on Tuesday, which no doubt is going to be big news. Then we have the FOMC interest rate decision. Then we have Papa Powell coming to piss us off. So that's probably where we're going to see that whole, higher for longer, higher for longer, higher for longer narrative that always comes out. Will the market therefore push yields up? And then we go here to Thursday, which is, of course, US retail sales. So a lot of news coming out. And then we've got some other stuff as well. So it's a pretty action-packed week, including the OPEX. You're going to need to be on top of it. Hopefully you enjoyed today's video. If you did, make sure to subscribe. And remember, take advantage of our VIP free weekly newsletter, 3rd edition coming out this weekend, where we'll talk about the interesting facts around what happens with Fed pivots. Thank you so much, everybody, for watching. We'll see you in the next one. Bye for now.